What is capital appreciation? Capital appreciation is when something you own, like a house or shares in a company, becomes more valuable over time. If you buy something today, whether it's a share, a piece of real estate, a painting, or even a bottle of fine wine, and a few years later it's worth more than what you paid, that increase in value is capital appreciation. But how does it actually work? When you invest in something, you're really buying a bit of its future. Let's say you buy a home in a neighborhood that's starting to grow. Maybe a new train line is being built nearby, making the area more accessible. As more people want to live there, prices can rise. And that makes your home worth more. The same goes for shares in a company. If the company grows, becomes more successful, and earns more money, people may want to invest in it. For example, the company might release a new piece of software that becomes widely adopted by businesses, boosting the company's revenue and visibility. Or it could expand into international markets where there's high demand for its services. That can push up the share price and the value of your investment. Now here's the key thing. Just because the value has gone up doesn't mean you've made money yet. In fact, until you actually sell the asset, that increase is known as an unrealized gain. It's only on paper. You only earn a profit, called a capital gain, when you sell it for more than you paid. Let's look at a quick example. You buy a share for £20. Later on it's worth £25. That £5 difference? That's capital appreciation. If you decide to sell the share, the £5 becomes your capital gain. That's your actual profit. So capital appreciation is about growth over time. It helps your investment increase in value, often without you needing to do very much at all. But it's also important to remember, values can go down too. If something loses value, that's called depreciation. It can happen if a company runs into trouble, or if the economy takes a downturn. Still, over the long run, many investments like property and shares have tended to grow in value. That's why capital appreciation is such a popular way to build wealth, especially for people who are thinking long term. Just remember, in some countries, you may need to pay capital gains tax when you do eventually sell and make a profit. And to be clear, withdrawing money from your investment app isn't the same as selling an asset. You only realize a capital gain when you actually sell the investment itself, not just when you take cash out of the app. So in simple terms, capital appreciation is when the value of your investment goes up. And when you sell it for more than you paid, that difference is your capital gain. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.